Okay, so every first Friday of the month, these two numbers get released, and they can literally send shockwaves through the global economy. So in this explainer, we're going to break down the U.S. jobs report and figure out what these numbers really mean and, why they matter so much.
I mean, just think about that for a second. There's this one single report. It comes out once a month, and it has the power to just completely swing the stock market, change the value of the dollar, and influence financial decisions all over the world. It's kind of wild. All right, let's get into it. The easiest way to think about the jobs report is like a monthly health checkup for the U.S. economy. And just like any good checkup, we're not just looking at one thing. We're checking a couple of key vital signs to really get the full picture of what's going on.
So our first vital sign, it's all about quantity. Pretty simple, right? How many jobs is the economy actually creating, or maybe even losing? This gives us that first baseline reading on its strength and its momentum.
And this number is called non-farm payrolls, or you'll just hear it called NFP. It's basically a headcount of the net change in jobs from the month before. And the reason it's non-farm is because farm jobs can be super seasonal, with harvests and planting, and that would just kind of mess with the data and hide the real underlying trend.
So why does this one number matter so much? Well, here's the bottom line. More jobs mean more people have paychecks, and more paychecks mean more people are out there spending money. And since consumer spending is literally the engine that drives the huge majority of the U.S. economy, NFP is one of the most powerful signs we have for how things are going.
But of course, the number of jobs is only half the story. Our second vital sign looks at the quality of those jobs, or more specifically, the cost. We do that by looking at how much people are actually getting paid.
And this is measured by something called average hourly earnings, or AHE. This one tracks the change in how much businesses are having to pay for their workers. So put simply, it tells us if our paychecks are getting bigger or smaller and by how much.
And this is absolutely critical because AHE is a massive signal for inflation. Think about it. If everybody starts earning a lot more money all at once, they've got more cash to spend. And all that extra demand can start to push up the prices for everything. We're talking groceries, cars, you name it. And that can lead to economy-wide inflation. All right, so we've got job quantity with NFP, and we've got paycheck quality with AHE. Now, let's talk about how you actually read these two vital signs together to get a complete diagnosis of the economy's health.
This really lays it all out, doesn't it? They're two sides of the same coin. NFP tells you about the economy's immediate power, its ability to spend. But AHE is like the warning sign. It tells you about a potential fever. That's the inflationary pressure. You absolutely have to look at both to get the real story.
And here's a little pro tip for understanding how the markets go wild over this. See, traders and economists, they spend the entire month trying to guess what these numbers are going to be. So when the real report drops, the market doesn't really react to the number itself. It reacts to the surprise, the gap between what was predicted and what actually happened.
Okay, let's look at a real-world example here. On this particular day, everyone was forecasting about 75,000 new jobs. But the actual number? It came in at just 22,000. That is a huge miss, a big negative surprise, and instantly signals that the economy was way, way weaker than anybody thought. That kind of news just sends ripples everywhere.
So that kind of leads to what feels like a simple conclusion. More jobs and higher wages, that's always a good thing, right? I mean, for the average person, yeah, of course it is. But for financial markets, well, it's a little more complicated. And, this comment from a user on investing.com just hits the nail on the head. It really captures that gut feeling we all have. I mean, why would a market ever react badly to people getting paid more? It seems completely backward. It feels, wrong. But there is a very specific economic logic at play here.
And here it is. This is the central paradox. If wages shoot up too fast, markets actually get spooked. They see it as a sign that the economy is overheating, and they start to worry that the Federal Reserve will have to step in and raise interest rates to cool down inflation. And higher interest rates can slow down business, which can be bad for the stock market. It's that classic, crazy case of good news is actually bad news.
Okay, so I know this might all sound like a bunch of high-level market talk, but the results from this one report have a direct line right to your wallet. Let's trace that connection.
So here's how that ripple effect works. First, the report comes out. Second, the markets react, like instantly, to any surprises. Third, the Federal Reserve, the people in charge of the country's money, they analyze this data very carefully. And fourth, they use that analysis to help decide what to do with interest rates, which affects the entire economy.
You're going to hear a couple of key terms to describe these reactions. A report that's stronger than expected is usually called bullish, which is positive for the US dollar because it signals a strong economy. And a weaker report is called bearish, or negative. These are just the shorthand terms for the market's mood.
And here is the final link. This is where it hits home. When the Fed adjusts interest rates based on data like this jobs report, it directly changes how much you pay for big-ticket items. That one decision can make your mortgage, your car loan, or your credit card debt either more or less expensive. That's the real-world impact. So, NFP and they are the huge vital signs for our economy right now. But as technology, AI, and automation keep changing the very nature of what work even is, it leaves us with this one final, really fascinating question. What's going to be the vital sign that we're all watching in the economy of tomorrow?